Good morning, everyone, and welcome to our course of the month for September 2019. Today is the 25th of September. We're glad you can join us. My name is Raul Aurora. I am the coaching and education coordinator here at Trading Winds, and always my pleasure to host these sessions with our head trader, Vince Vora, at this time. Sorry, not at this time. We're not doing a market chat, but we always like to do these sessions. We haven't done one in a little bit. We took the summer off. Hope you all had a chance to relax and enjoy. I do see greetings from Randy in Waterloo, Iowa. Stephen in Calgary. Stephen, nice to see you. Let me see who else is here before we get started for the day. Let's see if you can hear us and see us. Please let us know so that we are coming through loud and clear. Anthony in Boynton Beach. Anthony, haven't seen you in a while. Birgit in Broadway. Birgit, haven't seen you. Kathy, nice to see you as well from Highland Park. Gary in Madison, here in New Jersey. James and Mamel. John, and John, Charlotte, Chicago, and Roselle. Nice to see you. Naeem's here as well. Richard in Houston, Sandra, Salt Lake City, Sean in Sunnyvale, Vanessa in New Maiden. Vanessa, nice to see you. Nice to see all of you. Let's get started. Vince, good morning. How are you?
Good morning. Excuse me. I'm doing well, thanks.
Good. September 12th, we asked the folks what they wanted to hear and see in the next course of the month. So we've got five topics that you're going to be discussing today. I clearly didn't do a very good job at compiling the topics because you found some extras that I didn't find. So I think I'll have to take a demotion from that title that I had received, right? Which was Chief Compiler of Course of the Month topics.
It was actually executive.
Executive, yes, wow. That's right. Because the executive, just like the raincoat from Seinfeld. Anyway, we've got impeachment talk. We've got the markets doing not a whole lot, but more importantly than that, what is happening with BlackBerry? Is this the death knell for the company? Do I finally just throw the towel in here?
Should we start there? Let's quickly have a look. First of all, the markets are slightly higher this morning. They were lower on impeachment talk, and then Trump made a statement that a China deal may be coming sooner than later. How that happens is anyone's guess, but the market spiked for a bit, settled down, and now is slightly higher. Again, the Dow is up about 140 points. The S&P is up 8.5. The Nasdaq is up 32 points, and the Russell's up about 10 points or so. And let's quickly look at BlackBerry. Yeah, those earnings didn't go too well, unfortunately, and more importantly, broke this recent low here. So yeah, that does not look good, Ro. We're down to near the $5 range. We've cleared a lot of support here right now, and looking at this, no, we are not at an all-time low. That's $1.14, going way back to 1999. But certainly looks like we may be headed back that way after breaking the lows here. So unfortunately, not positive news for BlackBerry at all. And that recovery we were hoping for has all but fallen apart now, unfortunately.
For those of you that are not aware of my pain, Vince, if you can keep that chart up and keep your crosshairs right where they are, that just to the left of that, around the $76 mark, is where I thought I was getting a fantastic deal on BlackBerry.
Yeah. You were not alone. I saw a number of people do the same thing, not just on BlackBerry, but on other stocks, of course. There's one positive. Averaging now can really bring that price down.
Or if I were to sell calls against it for the next 99 years, I may do okay.
Right.
All right. Well, enough about my sunny disposition for this morning. Let's get into the topics for the course of the month.
Okay, so let's bring up the presentation again. I do have to say, obviously, trading can be risky, so please don't trade with real money until you're completely comfortable with the system you're trading. But these are the topics that were suggested at the chat where we asked everyone to sort of make a suggestion, and these were the ones, and I thought I'd cover them all in the hour that we have. Of course, some will spend very little time on, and others a bit more time on. But we'll start with options for beginners. We'll go over just a couple of the basics that you should know as a beginner, what you should focus on. We'll also talk about the inside bar formation, more importantly, when and how it's used, but also where it should be used on your chart. And we'll talk a bit about how to trade through a recession, since it is very likely we'll be in one very soon. We'll also talk about trading leap options as a way to get through this crazy market that we're in right now. And then we'll go over some of the need to knows for the Forex market. Okay. So it's going to be a jam-packed hour. I will share some of my notes with you. I'll just at times bring in my notepad like this, just so you can, there'll be a snapshot of these on the recording, and at any given point in time when you want to review the recording, we can, or you can just pause it there and have a look at my my notes and remember what it was that I was talking about there. So let me bring up my charts again here, and again, going through this, if there's any specific symbols you want to look at as examples, we can. But basically, if you are a beginner, or at least new to options, maybe you've traded forever, but have not had a lot of experience with options. So if you're going to start trading with options, these are some of the basics that you need to know. You really only need to focus on calls and puts, nothing else. Don't look at any other strategies, like even spreads or straddles or anything like that. Just stick with straight calls and straight puts. Okay, remember, calls and puts are another way to either buy or sell whatever it is that you want to own, be it a particular stock, an index, a futures contract, a Forex pair, whatever it is. It's basically a replacement for that underlying. So the calls will give you the right to buy a stock at a particular price, up until a particular expiration date. So let's look at Nike here. Nike gapped up, but has really come off that high right now. That's interesting in and of itself. But let's see if they can hold these highs here and remain above this this recent range. Anyway, we'll maybe touch more on that later on. So if I believe that Nike is going higher, I'm going to want to own a call. All right, and a call is just a contract that allows me to speculate on that move. A put contract is what would allow me or give me the right, but not the obligation, to sell shares in that underlying. Now, most option contracts are never exercised. They're just traded back and forth. So if I believe Nike is going to drop from here, I'd want to be the owner of puts. The main things to remember as an option trader is that whenever you're buying a contract, whenever you're going long, whether it's a call or a put, you can only lose what you've put into it. That's the maximum loss you could ever sustain. Okay, and that's the comforting point. If you're a seller, then you have more exposure, right? Because you're subject to someone else deciding when and if to exercise that contract. But if you're long, you get to decide if and when you ever do that. Now, the main things you want to look at for options, first of all, quickly on an option chain, there are numerous expirations, weekly, monthly expirations, and expirations that last years into the future, which are known as leap options. Now, regardless of how many there are, which one should you choose or should you trade? Well, should all be based on the time frame that you're trading. So if I'm going to trade off the daily chart, you want to look at call options or put options that expire roughly 3 months from today, right? About 90 days to expiration. Sometimes you'll have to go a little more, like the January's give you 114 days. There are times where you'll want to take less time, but generally if you're trading the daily time frame, you want 90 days. If you're trading the weekly, you want 6 months out. Yearly, you should look at leaps. Leap contracts or anything that expire more, at a minimum 1 year from now, usually up to 2 or sometimes 3 years out. If you're trading intraday, meaning a 3-minute, a 5-minute, 15-minute, even hourly, you can look at just trading weekly options. Okay. Now, which out of each one, so if we go to November here, you can see there's many strike prices. Which strike price do you want to focus on? That really is determined by two things. One is where you think the stock will be before expiration, or what kind of move you expect it to make. So if we go to the chart and we say, well, Nike's here at 90, but I think it can get back to 95, then you want to look at having a strike price that at a minimum allows you to be in the money before expiration. So you'd look at the 92.5 or max the 95. But the other component you want to look at is the delta. And the delta is a measure of how much the option will change in price compared to every dollar move up or down in the underlying stock or underlying market. So if Nike here were to move up $1 and we had a 28 delta on our 95 call option, once Nike makes that dollar move, we would gain, or our option should gain, about 28 cents in value. If Nike drops $1, we should lose approximately 28 cents. Okay, and these are dynamic numbers. They will change for every dollar move that the stock makes. So if it's moving higher, this will increase. If it's moving lower, it will decrease. Okay, and vice versa on the put side. All right. So the other question is, sometimes you want to buy an in the money option versus an out of the money option. In the money's more when you're expecting a very small move and you want to capture a bigger part of that profit. So in other words, if I buy the 85 strike, I have a 76 delta. So if I'm only expecting Nike to move a couple dollars, for every dollar, I'm going to make 76 cents, right? It's much different than 28 cents, but it's more expensive. So I have to take an initial risk that's a little higher than I would if I went out of the money, but could squeeze out more profit on a modest move compared to, if I expect a bigger move, I want to buy a less expensive contract. That way I can buy more of them, I can afford more, and eventually make a bigger profit. Okay. But basically, an option is a great way to replace a stock. If I was going to buy Nike and have to spend $90 a share, right? Even 100 shares would cost me $9,000. But if I went out and bought the 95 calls, they'd cost me $1.20, say max. Here are $1.19. So for 100 shares, which would be one contract, it's cost me $119, and that's all there is to it. So risk is much less. They can be leveraged. They're a fantastic tool. Also, on the put side, protective puts are great to use as a beginner trader, especially if you're used to trading stock. You want to buy and own Nike, for a number of reasons. You think it's a great company, you think it's going higher, it pays a good dividend, all that good stuff, but you want to protect your downside. All you have to do is marry a put to it, right? So if I was planning to hold this long term, say I'd go out to Jan 2022, I'd collect dividends over those years, and I would protect my position. Say I'd buy an $85 put. So yes, it's costing me some money, but there's no way I will ever sell my Nike shares for anything less than 85, because that is my right to do so, owning that put. Okay. So again, a very brief description, but for those beginners or at least new to options, calls and puts are all you need to focus on. Okay. Now, inside bar formation, and actually, I don't know if I had showed you this. Let me just put that on the screen for a second, just so you can see my notes and go back there. And next, actually, inside bar formation. Okay, so let me explain what it is, and then we'll talk about, where and when it should be used. Okay, so an inside bar formation is a bar. Let me see here if I can find. There's one right in here. It's right in here that didn't last very long. The big red bar. If we mark the high and the low of that big red bar. So an inside bar formation is when you get a bar followed by another bar that's completely within the high and that low. So if you look at this next bar here, the smaller red candle, it was completely within that high and low. That's an inside bar formation. Now, if you get multiple candles that remain within that range, that's known as a multi-day inside bar formation if you're using the daily time frame. If you're using the weekly, for example, it's a multi-week inside bar formation. Regardless, what it means is that eventually, when you get a break out of that range, either a break above the high of that initial inside bar candle or a break below the low, the longer we spent in that range, the bigger the move it should be coming out of that range. Okay, so they don't all work, but here's a great example of when and why you'd want to use one. First of all, a lot of times during a strong trend, a stock will make a move, then kind of consolidate for a little while, and then move again, continuation move in that trend. Well, within the consolidation phase is where you're likely to get an inside bar formation. You can certainly get one during the trend area, during the strong trend phase, but it's highly unlikely. Most of them happen during a consolidation phase, like we see in here. Now, you don't just want to take any direction on that play. You always want to trade with trend and with momentum. So here's a great example. We broke out to the downside here. We broke below the low of that inside bar formation, but it was just a head fake before a continuation of that move. Why? Because the trend was higher and momentum was still intact, and so this was a false breakout. We do not ever even want to attempt that move. In this case, where we have trend and momentum higher, we only want to look for breaks above the high of that inside bar formation, okay? And the longer we remain within this range, the more candles there are within this consolidation zone, the bigger the move should be once we move out. And so the longer it remains in here, the more interested we become, unless, of course, momentum flattens out or starts to roll over, etc. Okay, but and the only other way you want to use an inside bar formation is on a gap, and it usually happens around earnings, and you can use it for a momentum play. Now, today's gap on Nike is not ideal, but here's let's see if anyone can find one that's a better example. By all means, type in the symbol. But basically on a gap, and the bigger the gap, the better it is to play that inside bar if it happens. So number one, for it to qualify as an inside bar, we not only have to wait for today's candle to close, we have to wait for tomorrow's candle to close to know that tomorrow's candle is completely within the high and low of today's, right? But once we get that, whether it's just one candle or several, then we start to look for a break above the highs or the lows. Now, the reason why gap candles are good for inside bar formations is because generally after a big gap, if it breaks out to the upside, there's tons of room for it to go. That, you know, it's gapping in, it's moving above the high, which is in the direction of the gap to begin with. If it was gap higher, which means it's a momentum play. If it gaps below the low, because of that gap it left behind, that gap is likely to fill. So the bigger the gap, the better. And, you know, in this case, if we had an inside bar formation here, then we can play it no matter which way it breaks out, up or down. And all you want to do is once it breaks, you take that position and you put your stop on the other side of the inside bar. So if it breaks above the high, our stop goes down here. And if it breaks below the low, our stop goes up here, right? So it's also important that the actual inside bar candle itself is very tight from high to low. In other words, the gap might be huge, but the range from high to low on this, you'd want it to be very small if possible, right? That way you have very little risk no matter which way it breaks out because your stop would be close by, okay? Any questions on those first two topics before I move on?
Stephen in Calgary says, Vince, could you touch a little bit on the American versus European style options and if any European styles are actually traded in the US? John in Charlotte was asking, how about Walmart for the May earnings gap?
Thank you. Let's look at that. So American versus European, the only real difference is that the American style options, you can exercise at any time, or you can be exercised at any time from the day you purchase it to the date of expiration. The European style, you can only exercise or be exercised on the expiration date. So you're safe to hold it for the life of that option without worrying about getting exercised until that very last day. That's really the only difference. And there are some European traded options here, especially on ADRs and those kind of things. But they're not very common at all. Most of the equity options you see out there, or options in general, are American style. But it's always good to confirm that. Which gap was it on Walmart?
For the month of May.
The month of May? Yeah, there was no inside bar on the month of May. If I'm looking at the daily time frame here, going back to May on earnings, there was no inside bar formation there. So to be clear, it's not just a gap bar, like especially back in here, right? You got that gap bar, but the second candle was not within the high and low. See, it did close that gap, right? So that same sort of opportunity was there, but it wasn't an inside bar formation. We need a clear inside bar formation. Let me see. Yeah, I don't see one on Walmart. But anyway, they're quite common. You'll if you keep an eye out for them, you'll see them happen, but they tend to happen more in areas of consolidation. So if you look in here after this run, there's this big green bar here, where then this next little red bar was within that high and low, and so you mark the high and low and go from there. But of course, you want to trade with the trend, right? So we broke that low here, but all it was a pullback, right, to that 20 before a continuation of that move. So if this had turned out to be a multi-day inside bar formation and then broke out to the upside, those are the best ones to look for during that uptrend. And they do happen quite often, so keep an eye out for them. Any other questions?
Hiran was suggesting booking.com, BKNG, and John, who had brought up the Walmart symbol, was saying, I was thinking those bars around May 10th. I may be wrong.
Oops. Okay, I switched the way. I'll go back to Walmart and look at the May 10th area. Here on booking, I'm trying to find the gap. Heron, was there a date you were looking at specifically? Here, I think I'm missing it myself. Maybe this one. Well, there was one here that gapped up and had this huge range for the day and had a multi. Yeah. So if you look at this here, right, that's the high, that's the low, right? Now, the gap was very little, right, here, but we had a multi-day inside bar formation. And by the way, after that first candle that remains within the high and low, if you get a wick or a tail that sticks out here, but then it closes back within, that's still considered in that range, okay? A close outside the high or the low is what we're looking for. So as soon as we got that close out below the low here, since we were now below the cloud and had downward momentum, this is when you'd want to take, and you can put your stop either on the other side of the candle, which would be up here, or since this was a very wide candle and we had a previous high here, I would have put my stop right over here. But regardless, you can see what happened next. And so again, the longer you remain in that range, the more powerful the move should be coming out of it. So that's a better example. Let's go back to Walmart and look at May 10th and see, where's May 10th? Right around here. Cool. Yeah, this is the May 10th candle. So you see how the very next one, the wick is sticks out below that low? To me, that's not a true inside bar formation. Yes, the body is in there, but I like to see that very first candle be completely within the high and low. And then, for example, this one here where it would stick out, that wouldn't bother me so much. But I'd like to see the first one be completely within the high and low. Okay. All right.
Sorry, Vince. One more question. Gary and Madison, do you wait for the next day confirmation on a breakout?
Yes. Well, you would have to if you're trading the daily because you need a close outside that. And so then, so if it's a close above the high of that inside bar formation, the next day you're looking for any trade one tick or 1 penny above the high of the previous day, right? So yes, similar like we'd look for a trigger on our winning momentum strategy, same thing there, exactly.
Okay, let's keep moving.
Okay, so next I want to talk about how to trade during a recession. So just a couple of quick things here. From a technical perspective or a strategy perspective, nothing changes, right? The same things you look for, whether you're using WMS or any other veracity, any strategy, whatever you're comfortable with, does not change regardless of whether you're in an up market, a down market, a recession, a bull. It doesn't matter how good or how bad the economy is. The technicals are the technicals. But you can do a few things to sort of protect your account a little more. And one of them is to reduce the size of your orders or the percentage of account balance that you put into any one trade. You can just sort of pull back a little and tighten the reins a little on yourself during those times for a couple of reasons. One, those are periods where at least the initial downturn of the markets when the recession starts tend to be very volatile, you can see a very violent move initially. And so during that phase, by reducing your orders, if things go against you, they normally go against you quickly. And so you protect yourself that way by making sure you take a smaller loss than usual. But also, you can afford to go in with smaller size because usually if you catch the move, meaning if it moves in your favor, because things are moving so much and so quickly, that even a small position usually turns into a very healthy profit. So I'm sure you've heard that traders usually make a lot more money during down markets than up markets, and it's for that reason that usually any trade that you would normally do, the profits are amplified because the moves happen so quickly. But you've got to make sure you protect yourself because when it goes against you, it goes against you just as quick. So reducing your size or the overall amount that you put in a trade can really help during that initial stage. Okay. Also, your goal here is not so much to profit during that downturn. I mean, if you can and you're experienced enough to catch it, great, you can make a ton of money during that move. But your main goal should be preservation of capital, number one. So, all the money you make during your bull market, you don't want to give it all back. So you want to preserve as much of it as you can. And you also want to free up as much cash as you can because that downturn usually doesn't last very long. It's usually over very quickly. And when you see signs of a bottom, you want to have the cash available to get in there to take advantage of that ride back up, right? So by reducing some size and maybe reducing the amount of money that you use from your account. Normally we would have, say, half of our account in cash anyway, right? During that down move, maybe you want to go to 70%, right? That sort of thing. So regardless, you have a good amount of cash to put in once you're convinced that the bottom is in, right? And go from there. The other thing that you want to focus on during that time are puts on an index like the SPYs, the NASDAQ 100, the Dow, the Russell, right? So SPY, SPX, DIA for the Dow, QQQ for the NASDAQ, and IWM for the Russell, for example. There are others, but those are the main ones. And then you want to look at calls on safe haven bets like gold, like silver, like bond ETFs, that sort of thing. So you can look at playing the dollar. You can switch to Forex and trade during that market, on that market if you want to avoid equities altogether. But there are certainly ways to take advantage of it. And our next topic actually is a continuation of this in a way, because another suggestion was leap options to get us past this tumultuous market. Okay, so if whether we're in just a volatile stage like we are now, or whether we're in an actual down market or clear recession in the economy, etc., leap options are another alternative that sort of extend the time frame of every trade, but can be used to trade in a way where you're limiting risk while still leaving some upside open. Okay, so let me explain the different things you can do with leaps to take advantage of a scenario like that. Number one, if you're used to having a stock portfolio, say in a retirement account, and you'd like to continue to be active in the markets and keep those companies that you believe are solid, but you don't want to sit through the full drawdown during a bear market, you can use leap options to, number one, protect those stocks. So marry a put, buy a leap put to marry with that stock. That way you continue to hold the stock. You continue to collect the dividends it pays, and I would highly encourage you to focus on dividend stocks during that recession or during a down market anyway. Even if you were convinced you wanted to only purchase stock, no options, nothing else during that time, dividend stocks are what you want to focus on, because since they pay a dividend and have a yield associated with it, as the stock drops, the yield rises, right? So they will become more attractive to institutions a lot sooner than stocks that don't pay a dividend. Because as soon as the dividend yield becomes attractive enough, and in this environment, it won't take very long, because where else are you going to go for yield? Bond yields are super low and will probably remain that way and get even lower. So any stock that pays a dividend, as the stock drops, dividend yield goes up, more of that institutional money will pour into there and prevent it from going lower. So the dividend paying stocks will find a basement before the others, and will turn and start going higher before others. So you want to focus on dividend stocks. You can marry a put to it and sit tight for the next year or two and wait it out without a problem. You could also sell covered calls if you own the stock while having that protective put, right? So you can look at a caller trade, which is owning the stock, selling a covered call against it, and owning a put for protection. It's a great thing because many times the delta on your put and your call, which will work in your favor, both will work in your favor if the stock drops, right? Both will work against you if the stock goes up. But when you're in a down market, in a recession, chances are your stock is going to go down with the rest of the market. So your put and your short call will be making money for you. Okay, and then once we hit bottom, you can cash out of the put and the covered call, right? Close them out, take those profits, and reinvest them into the stock, meaning you're averaging down that way, and then you're resetting up another call or just a protective put going forward. But during that time, when other people just watch their stocks dwindle lower and see their net liquidation value dropping, you won't be doing that. You'll actually be profiting on the puts and the calls that you'll be using to put back in there later on. And when the market recovers, not only will you recover everything and more, but you'll have more shares. So you in the long run, you'll be making a bigger profit. Okay. You can just use the leaps as a stock replacement. So in other words, if I still want exposure to Nike to the upside because I think it's going to go higher, but I'm really worried because the whole market's going down. So and I'm not confident in my ability to read the ebb and flow of the market. I could just go to Nike and buy a leap call, right? Again, if I buy the share, it's going to cost me $90 a share. So even 100 shares is 9,000. If I go out to the leap and I buy a call option, right, I can spend a fraction of that, right? A fraction of it. I spend $1,000 and pick up a leap option, and if Nike does go higher, I'll make some money on it. And if it doesn't, then the max I can lose is 1,000 compared to here having 9,000 exposed, right? That sort of thing. So that's another option. And the other, lastly, is calendar spreads that we talked about the other day at the halftime during our chat. Meaning I can buy a leap call on a stock and sell the near-term months, or sell calls against it in the near-term month, so that as I wait out that down period in the market, right? And calendars are great during that time because, usually the stock drops, which means those calls that you write on the near months just quickly, turn into max profit each month, right? On that. And since you have a leap call, which is really the purpose in the first place, to own a very inexpensive or even a call that's completely paid off longer term before the stock bottoms and turns around. You can be selling those calls against it, take max profit on all of them, chipping away at the cost of your long call, and by the time the market turns and recovers, that long call will be, will cost you next to nothing, and in some cases you'll even have a credit by then. So during this, this market, or the what we think is coming, these are great strategies. Okay, any questions on that?
Just a comment from Robert. He says, this is a good webinar. Is this being recorded? Will it be posted to the website? Yes, Robert. As you probably know, I don't know if you received the notification or not, we're having some challenges with the members portion of the site. We expect to have them have those challenges fixed soon. If not, the session will be on a video format somewhere for you to access it this afternoon.
Okay. And last but not least, that takes us to Forex. And I'll go through this, a point at a time here. I'm not going to get into it very detailed discussion, but just to give you sort of a primer on it. The Forex market, first of all, is huge. Compared to the stock market, it's massive. It's the largest market in the world. As of Jan 23rd, 2019, the last sort of report I found on the size of daily transactions and so on, the Forex market was about 5.1 trillion that changed hands in the Forex market on a daily basis, compared to about 84 billion in the equities market worldwide. So they're not even close. It's massive. Now, the one thing I don't like about Forex is that it's an unregulated market, okay? But having said that, the bulk of the trading in the Forex market is done by banks, large financial institutions, and most of those are highly regulated. We know the banks in the US recently, a lot of those regulations that were put in after the 2008 crash have been taken back away by the Trump administration. A big mistake in my opinion, but that's an argument for another day. But most banks in other countries like Canada, for example, are heavily regulated. So overall, the unregulated part of this isn't as big of a deal as it may sound initially, but what is that there are regulated as well as unregulated Forex brokers that you can open an account with. So if you're going to do this, just make sure that you definitely use a broker that is regulated, okay? You do not want to trade with a broker that is unregulated. First of all, they're the ones that go under a lot quicker, and you can lose all your money that way very easy. But when you're unregulated, funny things can happen behind the scenes, so you don't want any part of that. Okay. Trading in Forex is not done at one location, like the NYSE, for example, but it's done around the world through ECNs, and it's all over the place. Now, the Forex market is 24 hours a day, except for weekends, so it's 5 days a week, and it starts off at 5 p.m. on Sunday. We use Eastern time, 5 p.m. Eastern on Sundays when it opens, and it closes at 4 p.m. on Friday. Okay, so over the weekend, there's no Forex trading, but from Sunday at 5 p.m. until the following Friday at 4 p.m., it's 24 hours a day, nonstop. Why is that? Why isn't it like the equity market? Well, because of the different time zones around the world. Banks need to do business, and they need access to funds in different currencies, and so to service their clients. And because of the different time zones, they need active trading. So trading goes on 24 hours a day. Now, it rotates. So there is a city that sort of opens and closes those markets throughout the day where you can trade. All right. So for example, New York is 8 a.m. to 5 p.m. Eastern, Monday to Friday, is where the Forex trades can happen in New York. Sydney, it's 5 to 2 a.m. and so on. So there's a rotation. So now the important thing to understand is when you hear that, the US dollar closed at a certain level, right? A certain rate. What it really means is that was the close in New York. So at 5 p.m. Eastern, that was the price. But 5:01 p.m. Eastern, it could already be at a different price, right? So when you hear, like, for example, I'll say on my videos, the dollar might have closed at this level, right? That was as of that 5 p.m. mark. Then it all changes again and it rotates, okay? The busiest and best times to trade as a Forex trader, what you want is volume, just like you do in the equity markets, right? You want volume. The best time and the busiest times are when these markets overlap, right? So, for example, Sydney opens at 5 p.m. Until 2 a.m., but Tokyo opens at 7, right? So 2 hours after Sydney opens, Tokyo also opens. So there's an influx of orders that come in at 7 p.m. And from 7 until 2, both of those markets are open. So there's more trading going on there than just a single time frame. You can see that when London opens at 3 a.m. until noon Eastern. Well, once it's open for 5 hours, then New York opens as well at 8 a.m. And so from 8 a.m. until 12 noon, you have both London and New York trading at the same time. So those areas of overlap are where you really want to be in front of your screen. And depending on your time zone, where you live, you may be up in the middle of the night looking for trades. That's the inconvenient part of Forex, or it can be very convenient for you if you work during the day, but those overlap times say happen in the evening for you. You can be an active Forex trader as well as hold down a full-time job, that sort of thing. But you want volume like anything else, and it's those overlap times. So what you'll find is the most active window is 2 a.m. to 11 a.m. Okay, that is the most active around Eastern. But whenever you get overlap, so say New York is open 8 to 5, but at London is open 3 to 12, but at 8 a.m. New York opens. For that first half hour, that hour that New York comes in while there's still trading going on in London, there's usually an influx of orders, okay? So there's spikes that happen that you can try to take advantage of. Now, you can trade currencies either with ETFs, like, like we show F here. Where are they? Here, FXA, right, which is the Australian dollar, FXB, which is the British pound, FXC, the Canadian dollar, FXE, the euro, right, FXF, the Swiss franc, FXY, Japanese yen. So there's an ETF for each currency. So you can trade them during regular equity trading hours, trade them with options like you would any other stock. Trade just like you do a stock. That way you can actually take advantage of the currency moves without learning a whole new way of trading, which is Forex, okay? And switching brokers or anything like that. So there is that option, or the only other way to do it is with currency pairs, right? So if you go here, here's the Forex trader on TOS, for example, and here's the Euro USD, right? And now at first glance, you may say, why is sell on this side and buy on that side? Well, because think of bid and offer. If you're going to buy, what are you going to do? You're going to hit the offer, right? So by clicking on the offer, you're buying. By clicking on the bid, you're selling, right? Now, since they're always paired, what you're really doing is exchanging one currency for another. So if I believe that the euro is going higher, then it's that first currency here that is what you're doing here. So if I click buy, what I'm doing is buying euro. Okay. So if I think the US dollar, right, is going to move, I can't click buy here because I'm buying the euro, meaning I think the euro is going up and the dollar is going lower. So if I think the dollar is going to go up, the only way to do it here is to sell the euro, right? I want to get rid of the euro in exchange for US and take advantage of it that way, okay? Sometimes it can be a little confusing, but you'll get used to it very quickly. All right, now they trade in different size lots. There's a micro lot, which is the equivalent of 1,000 units or $1,000 in this case. And if we're talking about US dollars, it's $1,000, right? There's mini lots, which are 10,000 units or the equivalent of $10,000. And then there's standard lots, which are 100,000 units or $100,000. So, you know, the way to calculate it is with a pip. First of all, let me not jump ahead here. Just about every currency is priced out to the 4th decimal point. Okay, you'll get used to this very quickly, but they make very small moves that can turn into very sizable profits or losses. A pip, or percentage in point, as it's known. A pip is the smallest increment that it can trade. One pip is as small as you can get in the Forex market. And depending on those lots, that's how you would calculate it, because one pip is typically 1/100th of a percent. So if you're trading a micro lot, right, and you only own $1,000 of currency, for example, one pip is going to equal 10 cents move, right? A mini lot, if you're holding 10,000, will equal $1, and if 100,000, it's $10. Okay, so now you may think, hey, I don't have $100,000 to buy a standard lot, right? But brokers offer a lot of leverage when it comes to Forex on margin. Okay, and we'll touch on that in a moment. And so they make it very easy for you to not only buy one standard lot, but many standard lots by tying up a very small amount of money. But that could really go in your favor, but it can also go against you very quickly. Okay? Now, some currencies can move upwards of 100 pips in a single trading session, sometimes several hundred pips, right? So if you're new to Forex, all right, or you just have a smaller account, you should only focus on micro or mini lots. Forget about standard, okay? Even if your broker's offering you some crazy leverage with margin, don't do it. Stick with the micro or the mini lots until you're very comfortable with it, okay? Because as I was saying, they do offer a lot of leverage, 40 times, 100 times. And so highly leveraged positions, sure, if they go in your way, can turn into big profits, right? If I bought 5 standard lots and was holding the equivalent of 500,000 US dollars, right? And the US dollar made a move like it did this morning, I could be sitting on a sizable profit. But I could just as easily take a huge loss. And one thing to remember, unlike the options market, in Forex, you can lose a lot more than what you initially invest, okay? So if that broker is offering me huge leverage you know, and I put up $5,000, but I'm you know, holding $50,000 worth of currency, right? And the move goes against me. I can lose way more than that 5,000 that I have tied in that trade, right? So here's an example. January 15th, 2015, the Swiss National Bank took the currency markets by surprise by unpegging the franc to the euro. So let me show you on a chart what that looked like that day. If we go to the USD Swiss franc pair, and I'll have to go to the weekly chart to show you. But look back in here, this area. Look at that move. That was a gap one day on that currency when they did that, right? So, you know, we open up and we're at $1.02 here, 102, and then we come all the way to 83 cents. I mean, that was absolutely enormous. Enormous. There were people short that or long that currency that, you know, lost their houses that day. So this is the kind of thing that when you have an unregulated market, so there aren't any rules stopping from anyone making a decision that would cause such a move, or there aren't any breakers in place, that sort of thing. And this is allowed to happen. And you have a position on margin like that, you know, if it goes in your favor, yeah, maybe you retire the next day. But if it goes against you, you quickly go broke. So it's very dangerous. So make sure you trade within your means if you're trading Forex, okay, or going to try it out. Start with those micro or those mini lots, and be very, very careful with it. Or, as I said, use the ETFs, okay? Now, news and economic data are what really drive the currency markets. It's different. Like the equity markets, most stocks are driven by earnings, right? Growth rates, all that kind of good stuff. But currency is all about economic data and news. So there's a couple of resources here that I want to highlight for you and show you. If I can bring them up. One is investing.com. And if you go to their economic calendar, this is where, for example, you can do it by today, tomorrow, or this week and see everything. Now, if you click the filter button here, you can select the countries that you're interested in. Because if you're only going to, say, trade the USD CAD, then you don't really care what Australia is doing or what Brazil is doing. You want to know what Canada and the US are doing, right? So you can filter some out or leave them all on, but they will, it'll tell you what the major announcements are and when, what time they're expected to be released, etc. Right? There's also a Forex section here. If you go on the markets, currencies here, where you can get rates. So if say Forex rates, they'll give you the main pairs and all the rates. So you can get one quick snapshot of what's happening around the world in the currency world, okay? The other one is Forex Factory. And this one is really geared specifically to Forex. So it has a calendar, if you click on here, has a calendar with the same type of announcements, but they're strictly the type of announcements that would impact those currencies. And they have an impact rating here, these colored little boxes. And so the gray is a nothing event. The yellow is just sort of, it might impact it a little, right? Orange, a little more, but red, those are the ones that can impact the currency significantly, okay? So you want to make a note of those red events coming up. And again, you can look in the future future date. So if I'm gonna, buy the euro, I want to know exactly when the manufacturing PMI data is going to come out, and so on. That may impact my position, right? And as you get more and more familiar with these announcements, you'll know what to expect. And you, similar to earnings on the equity side, may say, I don't want to be in the euro whenever there's a PMI announcement, right? I want to get out, and then after it's out, look for a move back in, that sort of thing. But these are great resources. Forex Factory also has forums and so on where people share ideas and so on. I haven't spent much time on there. I don't know how, if it's worth anything or not, but the calendar certainly is. The calendar on here, I would absolutely use. And again, you can, on the left, pick out the full week or a specific date, etc. Okay, so these two resources, hand in hand, I think will serve you well. Okay, now same technical strategies apply. Like anything else, you would trade the Forex market the same way you would trade stocks, right? Sure, some things are different, like, there's no earnings announcements in Forex, so you don't have to worry about that. But there's other news announcements, like we just talked about, that you would have to worry about, right? You'll get familiar with those things, but as far as the technical analysis aspect of it goes, it's all the same. So whatever you're using that's working for you in the equity markets, you can use in the Forex market. Now, here are the pairs that I would focus on. And they all have to do with either the euro or the British pound. Contrary to what most people might think, since sort of the currency that everything else is pegged to, which is the US dollar, most people tend to trade anything that's paired with the US dollar. But the currency pairs, I should say, that tend to be the most consistent as far as volume and trends that take place, all have to do with the euro and the British pound, but not the US dollar. So the Euro CAD, Euro Aussie, Euro New Zealand, and Euro Japanese yen, or British pound CAD, British pound Aussie, British pound New Zealand dollar, British pound Japanese yen. Have a look at those charts. They are very, very smooth. Let me give you an idea. GBPJPY. Okay. See, they trend very often. Within each day, there's lots of movement. Okay, they're not. You see how you get these little small bars here? That's far and few between. You get some sizable moves. So if you try to trade intraday, generally there's lots there. Like this is a 15-minute, and you can see some very beautiful, clean signals, right? So that's what I mean by those 8 pairs. There tends to be a nice ebb and flow to it that react very well to the usual strategies that we like to use. Okay. Again, you can use any pair you want, but these are the ones that tend to do very well. Now, here's the last point I want to make on this. My experience with that market, and it's not so much my experience because I haven't spent a lot of time actually trading currency pairs, but the people that I've known, the other traders that I know well that trade Forex on a regular basis, what they tend to say is that in the Forex market, more often than the equity market, within each day, so let's take one day at a time. If, say, the morning session, whatever it might be, right? So in New York, if you're trading the GBP/JPY in the New York session, it opens at 8 a.m., right? If the morning session, say, is down sharply like that, what you can expect is a retracement or some kind of pullback or consolidation during the lunch hour or the midday portion, followed by another strong move in that direction in the afternoon. It's very typical that the way the day starts out and the way the morning goes is how the rest of the day is going to go, minus that retracement. So when you see a strong move like this, you can expect that pullback, and that's going to be your opportunity, because chances are it's going to continue on in that direction for the rest of that session. So in other words, a currency is either in favor or out of favor on that particular day. Reason being is most of the volume comes from the big banks. So for example, let's say that, Deutsche Bank has a big client who has to close a large transaction and needs a lot of Japanese yen, for example, right? So they've got to go out and pick up this huge position of Japanese yen. So that is going to move the market. So in that case, you'd see this kind of thing, because if they're buying Japanese yen, it means the British pound is going to drop, right? And since it's the first currency in this pair, that's what, if you thought that British pound was going higher, you'd buy it. If you think it's going to be weaker, you sell it. So you'd see this weaken, then they take a break midday, it would come back, and then they'd resume their buying of Japanese yen, and it would sell off. Okay, that's very typical across the different pairs. And so one way to do this whenever you're trading is to monitor a group of pairs like this, and on any given day, see which one is the one that's standing out for that trend, and then follow that trend. Of course, you don't want to follow it blindly. You want to use the strategies that work for you all the time. But that's basically, in a nutshell, how you can get started in the Forex market. Any questions?
A few questions. Yes, Vince. What's the duration or expiration of Forex contracts? That's from Juan in Middletown.
Well, the pairs, that they're not contracts. You're actually owning the currency. So if I'm buying Euro CAD, I'm actually owning euros. So there's no expiration date there. There's no limit. So, and that's why, and because they trade 24 hours, right? If I go to sleep, I don't know what's happening during the time that I'm sleeping. So if there's some crazy news, it can really cause the pair to fluctuate. So most people, when they trade Forex, they'll day trade it, meaning they won't leave their screen until they close out that order. Or you want to make sure you enter that, those orders, that either the stop order or the bracket order, that will look after it if you fall asleep.
Stephen in Calgary says, how do you know if you're buying a micro, mini, or a full lot?
Oh, you'll choose. So when you go in, each platform is different. But say in here, you see the quantity, you put in your quantity, and you're choosing the amount that you want. So, whether you're buying 10,000, which is a mini lot, 100,000, a standard lot, right? You're selecting that on the order panel before you buy.
John in Charlotte says, Vince, I trade Forex and also find that FinViz is very helpful for relative performance information, so I know the trend for what should be weak and what ought to be strong.
That's great. So for everyone's benefit here, let me just type it in, finviz.com. Okay, that's what he's referring to. And yes, great site, also great resource for equities as well.
And Mel in Pendergrass says, Vince, what are some good ETFs for trading currencies?
The ones I showed you here. Now, there's more than just this, but anything that starts with an FX for each of the currencies. I've only got a few of the Aussie, the pound, Canadian dollar, etc. But they exist for most currencies. And these are the ones that have, sorry, this is the 15-minute. So go to daily. These are the ones that have decent volume, and more importantly for me anyway, they have very liquid options with tight spreads between the bid and offer. So you can trade these using options very inexpensively and without the learning curve, because you trade it just like a stock. So I really like those.
All right, we're just about 12 minutes past the hour, Vince. We're going to be seeing everyone again for the market chat in about 20 hours or so. What do we have coming up over the next, over that time?
Well, we've got to see, with this impeachment inquiry now, how as things start coming to light, I think it's going to cause the market to move more and more. Before we came on, Trump said he could have a China deal out soon. So who knows what's going on there. But otherwise, like we've been saying, we're just keeping an eye on the technicals here to see if we either break the highs here and ruin this potential head and shoulders top, or if we come out to take the lows on and confirm it. But right now, here we are. It looks like, I mean, there's still time. We haven't closed yet. It looks like we may get another long signal here. But this is I think what we can expect is more volatility coming up. All these hearings coming up and so on, just going to cause more and more uncertainty for this market. So I think volatility is the one thing you can count on.
All right, that is our course of the month. Heron wants to add that the transcript leads me to believe they are looking for a needle in a haystack, referring to the transcript of the call that you were just mentioning.
And that's going to be the challenge, right? There's going to be people that see it as a smoking gun, others that don't really see it as a big deal. But in the end, which way is this going to go? And throughout the impeachment hearings, with every piece of news that comes out about the president, or every new angle that they're investigating, it can cause the market to swing. So these, when you trade volatility like that, yes, it's good because it causes movement. And as a day trader, you'll love it. But as a swing trader, it could be very frustrating because even though you may have a solid long setup, for example, it starts moving your way, and then one piece of news like that comes out and boom, completely goes against you, or vice versa. So can be challenging. So be quick, with the trigger to bank profits when you have them.
All right, we will hopefully get our website issues resolved. If not, this video will be available on YouTube through a private link for you that we will send out to you this afternoon. In the meantime, enjoy the rest of your day. Happy trading, and we will see you at 10 a.m. Eastern, 10 a.m. Eastern, 7 a.m. Pacific time tomorrow for our next market chat. Vince, thank you. Randy in Iowa says, good job, guys. And Vince, please, thank you. Great little bits of knowledge, and we will let you know what our course of the month topic is for October 2019. If you have ideas, we always love to hear from you. info@tradingwins.com. Thank you, Stephen, Denise, Kieran, for the kind words, appreciate it. Naeem also says, thank you, Raul and Vince. I didn't do a whole lot here. Vince, I did almost everything. Vince, thank you, really appreciate it. And folks, we will see you tomorrow morning.
Thanks, everyone. Take care.